Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor. I'm back in the saddle this morning and have two co-cowboys. We have Gaurav, Sodhi. Good morning, Gaurav. How are you?
Yahoo, doing well. Thanks, John.
Yes. And in Canada, like where they actually have genuine cowboys.
They do.
Genuine cowboys there, the mountain.
Snow cowboys.
Snow cowboys. There we go. Good day, Graham. All right, we've got two subjects today. We're going to talk about an IPO or a company that recently listed that we have some interest in. It is the classic anti-AI stock. And then we're going to talk about AI itself and where this is all heading, because there seems to be growing recognition that this is getting out of hand. So that's our second topic. But we're going to kick things off with FDC Consolidated. Gaurav, when you were asked to have a look at this company, you yawned, I believe. And I would too, knowing what the company does. You just go, this is another low margin, mediocre construction business. You came out of it thinking maybe you were wrong to have that reaction to it. So tell us about FDC Consolidated.
Yeah, I did. The reaction was probably a bit more angry than yawn. I didn't really want to look at this stock. I just thought a builder, a construction business, I'm just not interested. Like they're never good businesses. You compile a list of the poor qualities in any company, right? You got cyclicality, capital intensity, terrible cash flows, project risk, and work in progress accounting, which can be tricky. You lump them all together, and there you have your classic builder. And I was very unexcited.
Yeah, and that's true all the way from the bottom to the top. Like you can look at your local builders, and they're struggling with exactly the same kind of problems that the really, really big builders do, and that tells you something about the industry. I thought that's why I wasn't interested in it.
Yeah, we did some work to the house actually before we moved in, and that's the thing I noticed most. I had an excellent builder who did great work and knew how to run his business, but he was constantly cash flow short and would always be, making sure I was okay. Payments well before the payment was date. Are you okay to meet this date? Is this okay? Is this going to come through all right? It was such a stress point for him. I'm sure he was a profitable builder, but that cash flow, working capital management is really, really difficult.
Yeah, and time consuming and stressful.
You see that being the downfall of many construction building businesses. So I was not excited by this. Look, one thing I will say that our previous research director and friend, Greg Hoffman, one of the exercises he always got us to do, and I still do to this day, when I come to a brand new business that I have never looked at before I open any of the accounts, I write a dummy set of accounts of what I expect to see. And I do that in common size. It's an annoying, time-consuming exercise, but I do find it leads to better outcomes. So if anyone else is looking at companies they've never looked at before, this I recommend. I've been doing this for 10 years now, and it's a wonderful way to we get to notice differences about a business without thinking they're obvious after the fact. And that's what really surprised me. So in my notes of FDC, I had huge amount of assets. I had low returns on capital. I had low cash flow. And I still had sort of lowish margins. And then when I looked at the actual numbers, I was quite stunned, because this is a business that does $1.5 billion in revenue, and it does it with about $1 million of employed tangible capital.
How does it do that?
And well, this is the thing. I was like, what is happening here? Where are all these assets? What kind of business is this? And the margins were lower than I thought. So we're talking about 10% gross, 5% net margins. And it's really small even for a building business. I was very puzzled. Then I looked at the cash flow and I thought, what is going on here? There's piles of cash flow. There's never been any debt. They're sitting on net cash. It's the only construction business I've ever seen where the pre-tax profit is higher than the EBIT. Like it because they're actually receiving interest income rather than having to pay huge amounts of interest.
Which is a clue about what this business really does, right?
And this is it. So this is not, in fact, what it appears. This is not a construction business. It is, in fact, a outsourcing company. It is a project management business. And when it takes on a construction project, it actually has built over sort of 39 years of operation. I think it's 36, actually, John. It's close to 40 years of operation. It's built up a network of contractors. It taps those contractors and it uses those to complete the work. It uses relationships and experience and reputation to find clients. And in fact, 2/3 of all their work doesn't even get tendered. And that also explains the unusual margin stability that shows up in their numbers as well. So this is not at all what I expected. I expected to see a capital pig with terrible cash flows. In fact, what I saw was an asset-light business that generates sensational cash flows, that's paid reliable dividends, and that has quite a unique business model.
Is all that cash flow because they're very aggressive with their contractor relationships, like a Woolworths or something? They push all of the payment deadlines out and that sort of thing?
Yeah, that was my initial assumption as well, Graham. But they don't really explain that. They're very good at managing working capital, but whether that's because of they're aggressive on the payment side or the cash release side, I'm not sure. But I do note that that the contractors they have, many of them have been with the business for more than 20 years. I forget the exact number, but it was disclosed. A very high percentage have been with the business for more than 20 years. And the client retention, the top 20 customers, 90% do not cancel contracts. So the customers seem happy and the contractors seem happy. So whatever they're doing to manage cash flow, it seems like it's working for all three parties. It's delivering sensational cash flows for the business, and the customers and the contractors seem happy because they're not leaving the company. So however they're managing that, they're doing it well.
It sounds as though they're doing what your builder would like somebody else to do for him, which is manage all the payments, manage the job, and you just turn up and do the job.
Yes. I'm sure that's the dream of many construction businesses.
Yeah.
The other thing that really impressed me here was that this is a company that's grown revenue from zero in 1990. And I think in 2004, they had like $100 million of revenue. And now they have $1.5 billion of revenue. And all that revenue has accumulated without any external capital. Very, very difficult to do. It shows a lot of allocation discipline. There's no big acquisition here. It's not as though they went out and bought companies. There is no silly capital allocation decisions that I can see in their history. Mm-hmm. So you marry a reasonable business model with management that has more than 30 years of disciplined capital allocation, and still retains big chunks of equity. They still own 60%. The founders will still own 60% of the business. And I thought that was quite attractive. The other thing to note here was that even though this was a private business, more than 50 insiders had equity in the business. So even as it was private, they recognized key people in the business and were happy to share equity. And I think that's a really important trait of long-standing businesses, that you have to give people equity stakes, and not many IPOs have insiders that have large chunks of equity. And then here you have a large number of people that do have equity. It reminded me a lot, actually, of Aussie Broadband. And the comparisons, there are other comparisons we can get into a bit later.
Interesting.
You may have questions.
Well, so why are they floating? If there's big insider ownership, why are they floating?
This is actually a big sticky. This is one of the reasons why we were happy to bring it into coverage, but didn't really want to stick a buy on it, even though the price seems fair and the track history is excellent.
You say that, it says that's on a PER of about 12 and a forecast yield of about 6%.
I know that sounds low, but this is still a construction and fit. Look, I should say 40% of the business is fit outs, which is not as cyclical, but it does have its own kind of demand drivers. When leases come up and when depreciation kind of gets too far ahead, then those are the triggers for fit out refurbishments, not necessarily the economic cycle. But to answer your question about the float, it does seem as though it's a classic cash out of the $400 million raised in the IPO, only $30 odd million is going to go onto the balance sheet, and they have no use for it. It's going to be general corporate uses because it's already net cash. This is really an opportunity for insiders to be able to cash out. And there's nothing wrong with that. We see this quite often, but it is rarely a great deal when the insiders choose their moment to cash out for sort of an outsider to come in and buy the equity from them. So I think I just wanted to see at least one result.
Yeah.
And hear from the business and see how they report numbers and see a full set of accounts before we decide to do anything further with the stock. But I did want to put this on people's radar, and we are going to be providing ongoing coverage. And I said in the review that this is interesting for what it is, and I do like the culture that's on display here and the long history of good returns and the considered use of capital. But I also like it because it's almost the anti-AI stock. I don't know about everyone else, but I am tired of AI everything. I have AI fatigue.
Are we going to do the segue now? I'd like to ask Graham first before we do the segue. What do you think of this company, Graham? Are you interested in it for those reasons, this being the anti-AI stock?
I think it is interesting that even though you can't pinpoint what its competitive advantage is, the fact that it's been successful for nearly 40 years is kind of suggests there is a hidden competitive advantage there somewhere, maybe in the relationships or in their institutional knowledge or something like that. So I think it's interesting for that reason. And with it being not a standard IPO where they're trying to raise money for the business itself, but it's just a transfer of ownership, I think that has a bit more attraction to me as well, because it suggests that the company isn't this big capital hog that is just going to require endless amounts of capital raisings to keep going. This suggests that it's the same business that's been around for all of those years without needing much. So I kind of like that there's some stability in the business that's kind of implied through the way they're raising capital this time as well.
Can I just jump in about that point you made, Graham, about a company not having an obvious competitive advantage? I used to think that was, and I think most investors think that not having an obvious moat is a poor thing. But I think times have changed and everyone is now looking for these same moats. I mean, everyone knows them now, right? Like network effects and pricing power. Everyone knows what these moats are. And these moats now get priced in very quickly and very aggressively. And what still remains an opportunity is when you have these companies that have a long periods of success, decades of success with no obvious clear moat. And so the moat is clearly then cultural or managerial. Right. And I mean, they can be fluffy because they're hard to quantify and they're harder to nail down, but that doesn't mean they're any less enduring. And when I said it reminded me of Aussie Broadband, that's kind of what I was talking about. I mean, recall that Aussie Broadband started in regional Victoria with over, I think it was like 100 or 200 competitors. It had no advantage at all. But the only advantage it has was that it was a vicious competitor and it succeeded in overcoming all its competition. And that was its competitive advantage, the hustle, the fight. A bit like Mrs. B from Warren Buffett for the law.
Yeah.
No competitive advantage in that store except the tenaciousness and the fight of Mrs. B. And I see those qualities here as well. There is no moat here. I mean, this is a low moat business. It is competitive. It is cyclical. And it is very hard to manage. The risk management here takes work. This project selection takes work, working capital management, and when WIP management takes work. But they've got a 36-year history of success. And that means that they've beaten down competitors who've come knocking and they've managed all those risks for a very long time. So I like those businesses that have no obvious moat, but have a long history of success. I think the market can sometimes be a bit dismissive of the strengths of those companies.
Does it mean there's a lot of risk then if the current founders are eventually going to move on and it's all tied to them?
Yeah. Well, what you see in these companies with sort of decades of success is that the behaviors become cultural and you see them all throughout the organization. I've certainly seen that in Aussie Broadband and in something like Macquarie Technologies. look, there's no evidence of that here. It's too early to sort of say that, but that tends to be, it's very difficult to, I think, to run a business for 30 odd years and not have the culture of the founders sort of ingrained throughout the business. But that remains a question.
This is a fascinating subject. I think that one of the problems with that saying that Buffett has about you want a business where any idiot can run it because eventually an idiot will run it, which implies that you need those competitive moats as protection against bad management. But when you get bad management into a good business, they can destroy it very, very quickly.
No question.
Very quickly. So I don't think that moats are as enduring as you think. And we've written up a few companies this year where their competitive positions have deteriorated just because of poor management. But on the other side, I think that culture can be more enduring than maybe a conventional moat if it's done in the right way over a long time. I think you can see that at Apple, for example.
Yeah, it's
probably an example of a good, enduring, innovative culture that doesn't take huge risks, but just does things really, really well when they do step forward. And maybe this is an example of that too, where the culture itself is the competitive moat. My experience inside most businesses, when you look at them closely or you work inside them, is that, they're not as good as they purport to be. There aren't that many good businesses. There are people who are in good positions who, are fortunate or something, but there's very few where the culture is genuinely innovative, a genuine competitive advantage. And when you find one, it's probably not a bad thing to hang on to it, even when there are no conventional moats that sit beyond it or outside of it.
I completely agree. If you've talked to anyone who works inside, say, CBA or Woolworths, two companies that we would describe as very strong franchises and in very strong competitive positions, the story is chaos on the inside for my discussions in any case.
Yeah.
It doesn't at all mirror what we think from the outside.
No. Graham, what's your view on that point? Culture as a competitive advantage?
I think it certainly is, but it's hard to, particularly for outsiders, it's hard to identify, I think. You've done a good job with your series on cultural analysis, but I think from outsiders' perspectives, it's generally pretty tough to identify compared to some other competitive advantages, but it's definitely a real one.
Yeah.
Look, the way to think about, the way I think about it is, I remember doing econometrics at university. And,
God, what a terrible subject.
No, I actually found I thought it was really interesting. I didn't expect to like it, but I actually did really enjoy it. But they talk about, when we hear about productivity, like productivity, no one knows, there's no measurement of productivity. Productivity is the residual of all the other inputs. So when you have economic growth, you take all the inputs and whatever's left is just called productivity because you can't measure it. And that's the way I think about cultural moats. Like if you can't really identify something, but you got a result over a long period of time,
numbers at the end of the year,
then the residual is cultural as a cultural moat. And you're right. Like that's probably not good enough for if you're a big bank broker or if you're a fund manager trying to, with $1 billion. Like it's very hard to hang your hat on a cultural moat that's a residual in your analysis.
Well, it's as you did with Aussie Broadband, and as I know myself as an Aussie Broadband customer, you have to tell anecdotes in replace of research, conventional research. And sometimes those anecdotes don't tell you that much. They're just a little window into how a company functions. Always remember that story that Wayne Jones tells of Gaines when he went into a Domino's in Brisbane and he saw the CEO answering the phone. That does tell you something about the culture of the company. It might only be a one-off. You need a long history of anecdotes before it becomes data.
Yes,
but that's just a very, very hard thing to communicate to people. It's much easier to bang out a spreadsheet and say, well, here's my price target.
And those anecdotes become more valuable when everyone else is leaning so heavily on traditional moats.
Right.
You have to do something different in markets to be successful. And if your differentiation is anecdotes, then do the anecdotes. You can't be doing what everyone else is doing.
Yeah, that's right. There was a good example. I was talking to somebody who knew the car industry fairly well a couple of weeks ago, and we were talking about Eagers and their switch to EVs, and to try and work out, how do you work out whether the lifetime value of a customer with a conventional vehicle is higher or lower than an electric vehicle? Because we all know they get serviced, less frequently, EVs, so you lose margin there. Maybe the resale value isn't as high as well, so you lose value there. How do you work all of this out? And he said, why are you bothering with all that stuff? All you need to know is Nick Politis thinks it's a good idea. And I kind of went, well, this guy probably knows the car industry better than anybody. I'm sure he's worked that out. Why do I need to know that?
He does know the car industry better than everybody. Yeah, the key moment in the Eagers AGM for me was when Pilates said to the group that the mob in Canada who he met were the best car people he's ever met, and that's why they did the deal. Yeah. For me, again, that was I'm sold. It adds so much to the confidence level when the doyen of the industry, blesses the deal like that.
Yeah, no, agreed. Anyway, look, we can't talk about Eagers again because we spend way too much time on the company. Let's move on.
Yeah.
So the FTC consolidated is the opposite of an AI stock. I've been reading up on SpaceX this morning. Just the SpaceX is now down below its float price. It's fallen 40% from its highs in sort of 2 weeks after it floated. This wouldn't be a surprise to us, but there seem to be cracks emerging in the AI story, and it is a story. I think it's a very, very strong narrative bias going on there. You mentioned in our Monday morning meeting, Gaurav, and Graham might be able to sort of correct this, but you have a friend who is a terrible investor, you described, and he tells a story that you think shows you where we are in this AI narrative right now. Can you tell us that story?
I have to be careful because my friend's going to be cranky with me. But yeah, I have a friend.
Could be another friend
who's very smart, very sharp, and is in a very high position in Australian finance. I can't be more specific than that because you might know him. But he's joining one of the hot companies, AI companies. And I just thought, for me, this is exactly what happens in a classic boom. In the 90s, the internet just sucked all the conversation, all the mental load, and all the oxygen out of everything into the internet. And people from conventional industries making a lot of money gave up their jobs and went to these startups in the hope of cracking it big. Capital abandoned traditional industries and ran to .coms. And you're seeing exactly the same pattern play out. Smart, well-paid people are leaving their posts and joining these AI startups in the hopes of a big IPO pop. Capital is abandoning anything that doesn't have to do with microchips and AI. BHP is an AI business, for goodness sake. Now, like you can see the similarities between what happened in '99. Like we're not the only ones saying this, but I think it seems so obvious to me. I don't quite understand why this is not more is not made of that comparison between what happened in '99 and what's going on now.
Yeah, Graham, have you got any parallels between now and the .com bubble?
Well, I think it definitely resembles it. It kind of makes me nervous, though, that it is so obvious that maybe, I mean, can we really be, as a species, falling for this trick again?
Again?
Everything about it does scream, this is a bubble, this is overinvestment, the valuations are completely disconnected from what the companies can potentially earn. And yet, we're standing here at the edge of the next big bubble and bust.
Look, I think we've got to be careful. Look, I want to make clear that I'm not saying that this is going to bust. Like I've been probably
nobody's saying that. I don't think
in the group I've been the most apocalyptic about software businesses. I would say I've sold all my software stocks, and I've no interest. I'm not touching them. Like I don't want to. I've seen what AI can do, and if I was a software business of doing anything, I would be terrified. And I think it's entirely appropriate for all these companies to have much lower multiples. Sorry, Graham, go ahead.
Yeah, no, I agree with you. I think that it is worth pointing out that there are still huge pockets out in the markets that don't seem particularly overvalued. We've got a pretty juicy buy list at the moment compared to
we do
historically. But yeah, there are also certain niches that are just completely
absolutely
crazy. So I feel like it doesn't have to be an apocalyptic view. You can just have particular companies and maybe even whole industries that go through a huge downturn when the rest of the market continues to do well. And I think also it's something that I often think about is the Microsoft parallel back in the dot-com boom, where people were paying a huge multiple for its earnings, but its earnings did continue to grow every year for the next 30 years or whatever. And but it took 20 years for people to earn their money back for those investments that were made in the 99-2000 period. Yep. So people can be absolutely right about the potential of these companies or the profits that kind of lie ahead. But if you pay too much for them, then it still destroys the investment case. So I feel like that might be with the situation we're in now, where you can be right about all of the AI potential out there, but that doesn't mean you're going to make money by investing in those companies at the moment.
Yeah, no, and I think you'll be careful about thinking like we don't know how this is going to turn out, and I'm always wary when uncertainty is priced as a certainty, and I feel that's what's happening now. Like if you look at these, everyone is in these chip stocks, right? And there's a lot of certainty that all these big AI companies, like look at the valuation of some of these neo clouds. These are terrible business models.
Yeah,
and
they're a sign in itself. I think when
I think so too.
Your model becomes like as an intermediary at this stage of the cycle, I think that is a sign of itself. The neo cloud.
There's a lot of uncertainty, and I just think the pricing is reflecting far too much certainty than what a rational person would assign to infinitely profitable AI tech. Which I don't think that's a zero at all, and be very wary of claiming that this is all going to burst. But we're trying to make sensible decisions, and when uncertainty gets priced as a certainty, that's where you've got to be a bit careful. I feel as though that's where we are now, and just this level of aggressive enthusiasm is worrying me, and I think there are other people as well. I heard a 40-minute speech by Jim Chanos over the weekend, and it just I should try not to listen to short sellers. I just find them scary, but they make so much sense.
I love listening to short sellers.
Yeah.
No, I do. I think they're great. They're incredible people.
They're the ultimate contrarians, aren't they? Yeah, but it's also the hardest way to make money that I can think of.
Oh, you'd be mad to do one. That's why I like them. I think they're absolutely insane to go out and try and make money out of short selling. It's just very hard. But if you can listen to any of them, I mean, the guy at Muddy Waters is really good, I think, and Jim Chanos too, remarkable character. So what was he saying?
Well, he was talking about some of the accounting identities for growth, and it's a bit dry, so I won't go into it. If you want to look at the speech, it's all over YouTube. But then he was also just talking about the similarities, what we're talking about, the similarities between 99 and now, some of the industries that have popped up, some of the business models, the movement of labor, the movement of capital. There are so many similarities that it's hard not to come to the conclusion that it's going to end the same. But I'm not quite there yet, John. I'm going to pull back a bit from that. And I think the reason, just to go back to FDC, the reason why this stock intrigued me and why it's actually on our ongoing coverage list is because this is back to the kind of stock I think is sensible to own at the moment, which is something that actually generates cash flow, that has no debt and has a low multiple. That's kind of the pool I'm playing in at the moment. I'm really trying hard not to be heroic, and I don't want complexity. We just want simple, high free cash flow businesses with no debt. And that's not always the case. I think there's time to take more risks in the market. This is not that time.
Yeah. Yeah. Graham, what do you feel about the companies that you cover? Do they offer the kind of, I'm hesitate to use the word safe havens because in a blow up, everything gets hit, tends to. But are there companies that we've got on our buy list now that you feel as though are good, kind of resilient companies that in any kind of blow up will probably perform pretty well?
Yeah, I think there certainly are. Because I tend to focus on the healthcare stocks, they always tend to be a bit, not correlated with the general economy and not correlated at all with AI stuff, I think, in general. So I think those companies are a bit more resilient. We've got ARB on the buy list, which is, I can't see how that would be too impacted by AI at the moment. And ResMed 2 is another good one. So although they pitch themselves to some extent as a tech company, but
before we give away all our buy ideas, Graham, let me just say that even though there are some excellent...
we'll say another couple of it, not confirm whether they're which are the real ones and not.
Just give them the first two letters of the ASX code.
Yeah.
We've got to be careful because traditionally the safe haven stocks are things like supermarkets, banks, Wesfarmers, Telstra. They are crazy. Like we have cells
safe
on
havens,
all of
not the safe haven.
Yeah, they are. That's the worst place. That's the worst place to hide at the moment. So that's why this period is particularly difficult, because those traditional safe havens are anything but safe. They are the worst place to be right now. And all those growth stocks are terrible. I think software is stuffed. Like it's difficult to know where to go.
It's funny though, because the buy list itself is very diverse.
It's very long, which is why people should take a look at it without us telling them what's on it.
Yeah. Okay, you guys got those two for free, but the rest of them you got to sign up.
Yeah.
But I think we've got quite a diverse buy list at the moment as well.
Yes, we do.
It's interesting that it's not just, we haven't just fled into one particular industry. There's quite a range there still. So I think those pockets exist.
I would just disagree with Gaurav about software being stuffed. I think there are some good software companies out there right now. And the prices are pretty attractive. So I would disagree with that. Maybe we can go into the reasons for that on a different podcast. But
look, I should highlight that my view is the outlier. I think that the team generally agrees with the view that that there are opportunities in software, and I'm alone in the view that I'm not interested in software. So we should make that clear to people listening. Yes.
Yeah. The other thing is that, I mean, I did a story on Friday where, you know, that I often talk about Carlota Perez, who wrote a book on technological revolutions. She's a sort of Venezuelan British economist. It's a fascinating book. I wouldn't say it's especially well written. She is an economist. But the parallel she draws between every technological revolution and the various stages in the technological revolution are really useful. So the story I did compared electricity to AI and how electricity unfolded. And I think it is a useful parallel. And if AI is what it purports to be, and it does conform to history and the experience that we've had as a species over various technological revolutions, from canals to electricity to the internet to AI, then the people who make the money out of this are probably not the people who develop the technology in the first place. You know, electricity wasn't Edison or Westinghouse that made a lot of money from building transmission lines and generators and power stations. It was the people who used the electricity to develop appliances. And it's much the same with most, I think all technological revolutions follow that path. If you look at railways and canals, they didn't make a huge amount of money themselves, but the ability to transport goods from one place to another allowed so many different forms of economic activity that was where the wealth was created. It was by people at the end of the value chain rather than at the beginning of it. And that's bad news for companies like OpenAI, which financially is an absolute shit show anyway.
Yep.
So it's just too early to know. It's too early to pick any winners, I think. But the chances are, if this is what the technology suggests, there will be winners. We just don't know who they are at the moment. And it was the same in the .com period. In the lead up to 2000, you couldn't tell who was going to be a winner. In retrospect, it looks obvious, but it isn't at the time. And that means, from a portfolio point of view, you probably need to be quite conservative. You want to check your portfolio to make sure you're not exposed to AI in some kind of nefarious way you don't really know about. You haven't checked it, and you need to be owning, good companies that aren't going to get hit if there is a crash, is a downturn, and are just going to continue and own them at decent prices. You guys got any comments on that?
I think it's interesting that the most use out of economists is when they pretend to be historians.
Yeah, absolutely. Yeah, because that's what economics is missing. Economics misses historical context because it's become so theoretical and mathematical. it's really useful when you combine the two. Absolutely.
When I was doing economics, they said that the subject had physics envy. And
absolutely. Yeah. That's
you can
right.
see that. Look, history is a lot of the books I read. I've stopped kind of reading investment books, and I haven't picked one up for ages. But I think the books on economic history are the most useful for investing, in my view, anyway.
And history itself. I think history is really useful too.
Yeah.
Graham, have you read any investment books lately? Before we go, just give us one investment reading book.
No, I'm much more the history fan. I think you can learn a lot more from the mistakes that other people have made in the past.
Yeah.
I reckon still company-specific books are really good. So the one I've picked up recently is the book on NVIDIA, which I'm about to start. And I think those company-specific books give you a lot of information about particular industries, and also about the individual driving these companies, or the individuals driving these companies, are really important. So to get to know their history and where they've come from is vital to understanding these companies.
Agreed. Okay, I think we're going to end it there. Greg will be pulling his hair out if we ramble on for another 10 minutes. So I'd like to thank you both for your contributions this morning. Gaurav, I will see you tomorrow at some point.
Yeah.
Graham, I don't know, we're going to see you next. When are you coming over to the office next, Graham?
Probably Christmas.
Christmas? That's a long way off. He's properly Canadian now.
Maybe before.
All right, everybody. Thanks for listening, and we'll be back with you in a couple of weeks.